Good morning, everybody, and thank you for joining us for today's Counterpoint webinar. Is South Africa in a fiscal death spiral? Certainly don't hope so, but we've got Daniel King and Rayan Ali, who makes up the fixed income team, part of the fixed income strategy within the larger Counterpoint, and they will take us through their thoughts on what the current situation is in South Africa in that regard, and I'm pretty sure they're going to add some food for thought. And so once again, thank you for joining us. As you know, Counterpoint is a multi-strategy boutique asset manager. Currently, we've got 5 different strategies that we house within Counterpoint. Those are the fixed income team that is represented today. We've got the payers and growers strategy, the quantamental core, quality, and then value. Just a bit of housekeeping before I hand over. We've got quite a bit of information to go through during the course of today, so I'm not going to lament these points too much, but we use GoToWebinar as a platform to host these webinars. For the best possible experience, please close down all other applications that you might currently have open on your computer or laptop or whatever. The first thing that goes when you've got bandwidth issues is your sound, so let that be a guide. Then CPD, we do apply for CPD points after the close of the session. If we get them approved, we will send out those CPD certificates to all qualifying audience members. Then we also have a Q&A box. We will have a few minutes at the end to attend to questions. So if you do have any questions, please post that to us in the questions box in the navigation pane. And then, as always, we have a small survey at the end. It's going to take a minute of your time to complete that. Your feedback is extremely important to us, so please do complete the survey for us at the end. It certainly helps to improve these sessions as we go. Without further ado, I want to hand over to Daniel and Rayan. Daniel will take us through the agenda, and we'll be handing over to Rayan thereafter. Thank you so much, Daniel. Thank you, Rayan.
Thank you. Morning all, and thanks for joining us today. We're going to deal with 2 issues in this webinar in an effort to understand really properly the risk and rewards associated with South Africa's fixed income market and also the broader investment universe in South Africa. Because when we're analyzing specific country risks, we like to think of the 2 macroeconomic pillars of smoothly functioning debt markets. That being firstly monetary integrity and secondly fiscal integrity. And we therefore need to understand South Africa's position across these 2 dimensions before we can make a complete investment case for South African bonds relative to international peers. So my colleague Rayan will be taking you through the reasons why we believe that South Africa's monetary integrity is a strength and getting relatively stronger in the global context, and how that really bolsters our case for government bonds, for example. And then I'm going to take you through some quite detailed analysis of South Africa's fiscal dynamics, which we think probably is the most important risk to our investment case, and which we believe needs to be managed quite cautiously across different investment class exposures, not only bonds. So there we're going to try to answer the main topic of the webinar, which is whether South Africa is not maybe already in an irreparable position fiscally. But before we get there, I'm going to hand over to Rayan to assess the first element of the equation, which is monetary integrity and the outlook for monetary policy in South Africa. So over to you, Rayan.
Hi, morning all. Thanks, Dan. Okay, cool. So let's just dive straight in here because I think we've got a decent amount of content to get through. So the slide here shows real policy rates, which is basically just the current policy rate minus inflation currently in the specific markets of South Africa and the US. I think it's important here we touch on regimes. So currently, what is each Reserve Bank trying to achieve? So simplistically for South Africa, since about 2000, we're trying to do inflation targeting and keep inflation between 3 and 6%, whereas the US has a bit of a dual mandate where they want to maximize employment and stabilize prices and long-term interest moderation. So I think let's just touch on the US here, for example, what total employment means or maximum employment. You're trying to increase employment to the extent where you're not increasing inflationary pressures in the market. So For a long period of time, the US have kept low rates and easy financial conditions, and this has caused massive asset price inflation, creating a wealth effect where people just feel wealthy and they don't feel like they need to work, for example. And that's currently an environment that we're currently in. You'll see that a lot of people are not going back into the workforce in the US. So what happens here is that you have to have companies that are going to go and have to increase wages in order to bring them back in the market. So the US has this potential to be able to raise rates and kind of decrease that incentive or go and knock asset prices. They haven't done that yet. So far, we have inflation at about 8% in the US, and the Reserve Bank in the US, or the Fed, for example, are not actually addressing it. At the moment, they're basically conducting monetary policy over Twitter and trying to change the course with changing expectations. Just on the stable prices, they're targeting inflation of about 2% since 2012. Just if you look at this chart here, that filters into the real rates. And if you were to compare the US versus South Africa here, you'll see that the US has negative real rates for a decent chunk of time since 2004. How we see this as a relative monetary stability or prudence is that South Africa is actually addressing inflation faster than what the US is, and that gives them better credibility in which they're trying to address problems, whereas the US has just prompted low interest rate environments to go and preserve growth. So just on the next slide, Dan. Yeah. We're trying to explain the credibility of the Reserve Bank and the track record since taking on the regime change. They did this at the beginning of 2000. Prior to 2000, you can see how volatile inflation is. This is a chart of CPI inflation year on year. 2001, 2002, and GFC are the big spikes after that regime change happened. So stripping that out, you'll actually see that we've maintained a inflation rate between 3 and 6 relatively comfortably. And I mean, the takeaway here is to state that the SARB has actually gained significant market credibility. I mean, during this time, we've obviously had the government or let's say the fiscal side trying to overtake the SARB here, and they've managed to fend off those takeover attempts on numerous occasions already. So in terms of just independency as well, they're doing what they think is right and maintaining inflation dynamics correctly versus prompting growth and those type of things, which is not exactly politically palatable. If we just delve further onto the next slide, yeah, we're looking at monetary policy and what we think is actually going to happen. So prior to COVID, we had a repo rate closer to 7%. During the pandemic, much like the rest of the world, we cut rates quite aggressively to go and aid the economy. So since we've had the vaccine announcement here, we have rates ticking up moderately, 75 basis points since the 3.5 bottom. And this is basically the theme that is playing out globally at the moment, is with high inflation, there's going to be some form of policy normalization. And just based on the FRA curve, which is derivative instruments which predict where the short-term rates are going, you can see that in the dotted line there, we expect that the repo rate will go back towards around about 7% according to the market. We may personally disagree with that if it's slightly too high, but that's basically what the market is being priced in at present. I think this is just important to take into account here, is that when we speak about central bank credibility, we can actually place a decent amount of emphasis on these numbers because they're actually believable, and we think that the Reserve Bank will go and follow through with what they are actually forecasting. On the next slide, we'll see basically how this repo rate movement ties into inflationary expectations. So on the right-hand side here, inflation expectations with the rising interest rates that we're expecting in the market, these will temper inflation expectations. The numbers on the right-hand side is actually surveys conducted by Bloomberg of asset managers and market participants here in South Africa. And it seems like it's consensus that not just us, but the rest of the market actually believes and trusts the central bank here. And with those rising interest rates or repo adjustments, you'll see that inflation then tempers off, and that's where we think that the SARB actually scores exceptionally well, is on the monetary aspect, is that rate hikes, they do what's prudent and they address the issues, and the market believes exactly what they're going to forecast and do. And that makes basically forecasting anything going forward a lot easier and a lot more credible. So when you are making long-term economic decisions, these are foundation to that. And I suppose this takes us to the opportunity of South African government bonds. Given the expectations of average inflation not exceeding 6%, long end of the curve basically giving you opportunities of real rates in excess of 5%. So we don't however close our eyes and purchase bonds here. Daniel will go and take you through the further discussion of the fiscal dynamics. As he mentioned earlier, those could pose risks, and we'll see whether we're being adequately compensated. But I think first, we're curious to see where you, the audience, believe South African rates are actually going. And that takes us to our first poll.
Thank you, Rayon. So the first poll that we're launching is, how do you expect the repo rate to change over the next 12 months? And the 5 options we've got available is decrease, no change, increase by less than 100 basis points, between 100 and 200, or more than 200 basis points. We've got about 40% of our audience that have voted. I'm going to leave it open until we have more than 60% that is ticking up. So if you don't mind just giving us your vote on the various options that are available. I'm going to give it another 5 seconds. There we go. And I'm going to close. Let's just share the results. So the results from our audience, we've got 2% of our audience saying that or at least of our audience that voted, that says they're expecting a decrease, 1% no change, increase between 30 of less than 100 basis points, 36%, increase between 100 and 200 at 57%, and then increase by more than 200 basis points at 5%. Good, that takes care of the poll. Daniel.
Thanks, Yaku. Just confirm that you can see the screen that I'm sharing again.
I certainly can. Fiscal policy dynamics.
Okay. Great. Yeah, I think the results of the poll are more or less in line with what we're thinking, although less hawkish than what the forward rate curve is pricing in, which tends to be on the more extreme end of the poll result, more than 200 basis points over the next 12 months. So very interesting to see where we actually end up, considering that the Fed, which tends to, kind of lead emerging markets in a certain direction, is expected to hike rates as much as 50 basis points as early as today. Moving on to the fiscal element of our analysis, which is really the core of this presentation. You can see a chart which I think would be familiar to those of you who have participated in previous webinars shared here, which is a scatter plot. And our investment case for South African bonds has historically partially rested on the position of South Africa on this scatter plot, which compares nominal bond yields on the x-axis against a measure of potential nominal GDP growth on the y-axis. And the logic here is that in the international experience, deviations from or between the two figures don't tend to persist forever. And with greater and greater credibility on the inflation front, which I think Ryan has covered, South Africa's nominal bond yields will tend to decline towards nominal GDP growth, providing some potential capital gains and a very high real income along the way as well. But as our thinking has evolved, we're not, and we can't really be naive to the risks associated with this investment either. And that's what we will be examining in this section of our presentation. Because the fact of the matter is, if you look at this chart here, you can see that South African government debt is rising fast, faster than many of its peers, in fact. And we need to understand why that is the case if we're going to get a grip on how the risk may evolve over the next 10 to 20 years, which is typically the horizon over which you're lending money to the government in the event that you're purchasing these long-dated bonds. So I'm going to introduce an analytical framework which is slightly technical in order to show you how we can understand the stability or the instability of government debt. And I do want to clarify some terminology before we do that. The first is just to say that when we refer to the primary budget balance, we mean the difference between non-interest revenue and expenditure. So that's the primary balance. The second point here is that when we refer to the debt stabilizing primary balance, we are referring to the primary budget balance that would maintain the public debt at the prevailing level as a percent of GDP. So that is really the key point to get across here, that there is a primary budget balance that would stabilize debt, and then there's the actual primary budget balance. And we need to understand how far apart those two figures are in order to understand how stable or unstable public debt dynamics are in a country, any country, including South Africa. So how do we calculate this debt stabilizing primary budget balance? You can see here that it's actually quite straightforward and set out right here in this pretty rudimentary equation, which we've dubbed the golden rule of public debt dynamics, and which we're going to use for the South African case and the peer group markets. So what this equation tells you is that the debt stabilizing primary budget balance is a positive function of, firstly, the debt to GDP ratio, and secondly, the difference between interest rates and nominal GDP growth. So that's very, very important. So this equation is quite powerful because it tells us a few things. Okay, the first is that for countries that are in a net debt position, if interest rates are higher than nominal GDP growth, you will need to run a primary budget surplus to stabilize the debt trajectory. And secondly, if that is the case, as debt to GDP rises, the primary budget surplus that is required to stabilize debt dynamics itself becomes larger and larger and larger. So it becomes much more difficult to stabilize the longer this difference persists, the longer interest rates remain above nominal GDP growth in that case. So don't get lost in the weeds here. Let's first have a look at how we can use this tool to analyze South African debt dynamics. The first thing that we would need to do to use this equation is to establish the relevant level of interest rates. Okay, obviously there isn't only one interest rate in the economy, and the government will tend to issue debt across the maturity spectrum, across different kinds of instruments, and so we really need to look at a blend of those things to understand what is the average cost of debt on this government debt burden. As you can see in this chart, there is a pretty significant discrepancy between short-dated and long-dated bond yields, which really is the interest rate that's faced by National Treasury in the capital markets. And that discrepancy is very wide by historical standards. So this is telling you the yield curve is very steep, and it's not so simple to just use one benchmark interest rate to determine where your average cost of debt lies at the moment. So we need to assess the maturity profile of Treasury's debt liabilities. And you can see here that it's more or less evenly spread across maturities up to as much as 30 years from now, going to almost 30 years, 2050, which historically has actually been regarded as a significant strength of South Africa's debt profile. The fact that we've really been able to term out our debt nicely and avoid liquidity risks. It's not necessarily a strength when your 30-year debt yield is, your debt is being raised at more than 11%, but we'll come to that later. For now, I think what you can do is a really reasonable rule of thumb would be in this case to just use the simple average across the yield curve, which because of how termed out the debt is, currently that's approximately 9%. Historically, that's a pretty high level if we compare that to the post, GFC trend or even inflation. So we need to assess where this 9% average cost of debt compares to nominal GDP growth potential. So we've got the R, now we need the G for South Africa. Now, to get the G, you can use all sorts of techniques, but I prefer to use IMF estimates of rolling nominal GDP growth, which also include a forecast over the next 5 years, conveniently. And what the IMF is saying is that under current constraints, South Africa can only really produce real GDP growth of about 1.5% sustainably. And with inflation at around 4.5%, that's only going to generate around 6% nominal GDP growth. So that's what they reckon is the current potential growth rate, nominally speaking. So here we have the potential issue, because the average debt cost of around 9% is materially higher than this forward-looking nominal GDP growth potential, which is potentially closer to 6%. So in other words, we need to run a primary budget surplus to stabilize the debt trajectory under current conditions. And if you look at the track record in that regard, perhaps that is at risk. The last time National Treasury ran a primary budget surplus was here in 2008. Under the current expenditure plans, you can see the IMF doesn't expect to see a primary surplus over the next 5 years, which I think is understandable given this experience of the last decade. So if we refer back to our golden rule here of debt dynamics, what is actually required of the South African government in this scenario? Well, if you plug in the current net debt to GDP ratio of 63%, and then interest rates of 9%, which is your R, and then nominal GDP growth of 6%, you would derive a primary budget requirement that is equivalent to a surplus of almost 2%. So keep in mind that we're currently running a deficit of around 2%. So there's a 4 percentage point differential there of GDP. So that's really the primary risk, because that is implying that under current conditions, we are quite a distance away from stabilizing government debt. And the longer that these conditions persist, the wider and wider that gap is going to get, and the more difficult it's going to be to stabilize debt. So that's if nothing changes, okay? If nothing changes and debt to GDP continues to rise along its current trajectory, we are over the course of the next 5 years going to be spending, as much as 8% of GDP on the government's interest bill alone. And if you extend that really far, over the next 20 years or so, that dynamic can get explosive. So if you look at our situation relative to the international situation, given the current mismatch between yields and growth in South Africa, and then adding the primary budget deficit to that, South Africa's debt dynamics are almost amongst the least stable in our sample, actually, second only to Brazil, who face a very similar challenge to us. So what can be done to fix that? What needs to be done? The one thing that, in theory at least, can balance our golden rule equation here is to run a big primary surplus. So basically a targeted austerity program. So you can see from this scenario analysis here that if we continue to run really significant primary deficits, like 3%, 1.5% primary deficits, the debt to GDP burden gets quite crazy. I mean, up to 180% in the worst case scenario by 2040, and it will continue to rise. But if we, for example, if we improve the primary balance to a surplus of 1.5% to 3% over time, under the current conditions, holding everything else constant, things start to look a whole lot more stable. So basically, stabilizing at the current level or even improving over the next 20 years. But is that level of austerity, really realistic? Probably not when we consider the nature of government expenditure and revenue as it stands today. So obviously, on the expenditure front, The overwhelming issue is efficiency of expenditure, of course. But if you hold that constant and just start to cut the budget, it's really only wages that is a plausible target. That's really the only meaningful chunk of government expenditure as a percent of GDP. Obviously, the grants expenditure is highly politically charged and probably not wise to impose cuts on. So I know this wage bill is a popular target for analysts, but I'm not so sure that it's an optimal strategy for South Africa, given that we don't necessarily have a dynamic labor market to absorb retrenched government workers. Really, if you were to raise 4% of GDP from cutting wages, it would mean that hundreds of thousands of people lose their jobs. And we really are talking here about, if you look at the sectoral mix of that expenditure, in reality, if you want to cut into this wage bill meaningfully, it's going to be teachers, nurses, and police officers here. And as I said, you run the risk of undermining GDP growth, which you also need to stabilize debt trajectory because of the lack of dynamism in the existing labor market. So it's almost a case of being cautious and careful about what you wish for, I think, in this case. On the revenue front, the level of austerity which would be required to achieve a big primary budget surplus seems, I think, even less realistic. It's in doubt whether government could plausibly pull any of the major tax levers without causing a response from taxpayers, which could possibly undermine that effort. So in many instances, for example, in personal income and corporate income tax, there's an argument that we perhaps are on the other side of the Laffer curve, meaning that increases in your marginal tax rate could actually result in a reduced tax intake due to a response from taxpayers. So really that leaves things like fuel levies and sin taxes, which would need to effectively double to raise the amount of revenue that is required to stabilize the current debt, debt trajectory if bond yields and growth remain where they are. So it really doesn't look like it's likely that this debt stability equation that we see here gets resolved through austerity measures, and austerity measures themselves would risk this element of the equation, your nominal GDP growth potential. It would risk undermining that growth outlook even further. But what else can move in this equation? It is firstly the difference between R&G, which may change over time, and other under the current budget framework, the debt trajectory is extremely sensitive to that assumption. Secondly, you could also see privatization of assets, which could take a chunk out of the 63% as a once-off shot, which also makes the required primary budget surplus that much more attainable as you start from a lower starting point. But let's test these R and G and primary balance assumptions against various outcomes for the debt trajectory over the next 20 years. There are two scenarios basically that I'm painting here, and they are very, very different in their outcomes, but it illustrates how sensitive this modeling is to these assumptions. So, for example, if the Eskom constraint is relieved, or we continue to get the benefit of higher commodity prices over the next 5 years, it is plausible that 3% real GDP growth and 5% inflation or so become more normal. And these things will tend to correlate and feed off of each other. So in that scenario, you might find that bond yields also decline by 100 basis points or so. And it's easier to achieve the primary budget balance improvement, maybe by 1% or so relative to the current baseline or current projections. And what you see in that scenario, which is really not a huge stretch, is that the debt burden stabilizes at current levels and even slowly improves over time. And as I said, these things will tend to correlate like that. So in this scenario, you're potentially facing really the opportunity to actually earn that 5 or 6% real yield on your South African government bonds, probably in conjunction with a 10 to 20% capital gain in that scenario. So it really would look like one of the top performing asset classes in that scenario. But as it is sensitive to that scenario, it's also extremely sensitive to the downside. So if nominal GDP growth is maybe as low as 5%, which is where it really has been over the last 3 years because of the impact of the pandemic, then you might find your bond yields are 100 basis points higher or so. So your cost of debt starts to be impacted by that as a government. And it's even more difficult to achieve primary budget surpluses, and you might even run a wider primary deficit as your automatic stabilizers start to kick in and your revenue collections are lower. So there you get something like this where you really are heading for a big structural adjustment, and you have, your debt to GDP ratios getting into the 200s over the next 20 years. And that's the kind of thing that obviously could precipitate a big currency adjustment or something like that. A pressure valve would need to release that tension some way to get probably nominal GDP growth higher through the mechanism of inflation, potentially. So the point is, I would not put too much emphasis on a specific baseline view, but what we do know is that if the inflation credibility which the Reserve Bank has built and continues to build continues to manifest going forward in a moderate inflation profile and contained expectations, these bond yields which we're seeing today, and in the longer end of the curve, it's now at 11%, they're more likely to align with nominal GDP growth over the longer term, and the more positive trajectory in that case is much, much more achievable. So on that note, I do want to run the second poll which we've prepared, Jaco, before we wrap up with some final thoughts, and then we're going to go into a Q&A. Jaco, could you run the second poll?
100%, Daniel. Right, so the question we're putting to our audience is: the 20-year government bond currently provides a yield to maturity of 11%. So what are your views on what inflation would or could be over that period? So our options that we've got available is below 3%, between 3 and 6%, between 6 and 8, and above 8%. So if you don't mind just giving us your opinion, I see you guys are voting away. Thank you for that. We're above 50%. Going to give it another 5 or 10 seconds or so. There we go. Thank you for your response. So let's share what our audience feels. So the results are, sorry, I just need to get my navigation pane out of the way. 1% below 3%, certainly in the minority. 35% between 3 and 6, 54% between 6 and 8, and actually 10% of the audience thinking that it could potentially be above 8% over that period. So I don't know if there's any surprises for you in there, Daniel, or if there's any comments that you'd like to make on that.
Yeah, I think clearly the great majority of the respondents are between 3 and 8%. And that puts South African real yields in the majority of our viewers' minds at a positive number, positive something. So ranging between potentially positive, 7% to positive 3%, but certainly more potentially much more attractive valuation than what you would typically find in developed market bonds currently, where there really is very little prospect of earning a real positive income over the next 20 years, given where yields are currently relative to where potential inflation is. So I just want to run through some investment implications before we go into a Q&A. I think there is quite a lot to digest here. The first is on how our views are evolving with respect to the risks and rewards associated with government bonds. We are still relatively bullish on the outlook for South African government bonds and typically relatively overweight in the fixed income franchise. And that's because we think the valuation should resolve over the next 5 years or so. But where our thinking has become more nuanced is that we've realized and appreciated that these bond yields themselves are not only an opportunity, but potentially a threat if they persist at these levels. So in other words, the bond yields are endogenous to the system. They are actually the cost of debt ultimately for an entity which has negative operating cash flow. And so we need to adjust our forward-looking assumptions to account for the fact that the government is going to continue to raise debt at these levels. So the irony is that the longer the bond yields persist at this level, potentially the less attractive they become. For debt stability to improve, we unambiguously require one of three things by definition. Either higher nominal GDP growth, and there we obviously would prefer higher real GDP growth over higher inflation, but either would stabilize the debt trajectory. There is a risk in that the political temptation is always to go the inflationary route. Or lower bond yields. And this is actually quite an important point because we don't think that the current strategy of National Treasury is optimal. When I showed you the debt maturity profile, which looks very impressive going out 30 years at a national level, I made the point that it historically has been regarded as a strength of the South African government, and they've been rewarded for it when nominal GDP growth has been high and your bond yields has been relatively low compared to that nominal GDP growth. But under the current circumstance, if you're raising 30-year debt, 20 to 30-year debt at a yield of 11%, that is inherently unsustainable unless you can grow at those levels. So we have argued previously that it is actually optimal, at least if in the short term and only in the short term, for Treasury to reduce its maturity profile of issuance to manage the cost of debt more thoughtfully, similar to a way in which a management team of a listed equity would respond to the cost of capital. The South African government needs to respond to their cost of capital by reducing their issuance of that really, really expensive debt. That's one way to artificially lower bond yields in the short term, but it's not sustainable because it introduces liquidity risks. It can only be viewed as a short-term measure. Then the third and final option that they have is to materially increase the primary budget surplus that they're targeting over the next 5 years. We're really only looking at breaking even in year 5 under the current expenditure and revenue plans. But of course, that is, for us, this is the third best option because it's much easier said than done, firstly, politically speaking, without risking your political life. And secondly, you actually do run the risk of being counterproductive if you don't have a dynamic labor market which could absorb the number of people that is implied in this primary budget surplus, the number of retrenchments that's implied in that surplus. So potentially that comes with risk. In fact, we've written historically about how we think that because the South African economy is so capital constrained, the optimal strategy from a fiscal policy perspective is probably to aggressively subsidize corporate tax, aggressively subsidize capital expenditure locally to the greatest extent possible. We would argue for a depreciation allowance of 100% in year 1 of any capital expenditure that takes place in South Africa. And that would actually widen the deficit initially, but we believe it would cause a J curve in the budget deficit, and so actually ironically stabilize forward-looking projections of the government debt burden. So we wouldn't argue particularly strongly that the government should be running bigger surpluses currently. There are risks associated with that, and if anything, they should be reducing tax in some quarters. So for our bond thesis to play out favorably, we do think that, in line with what Ryan was highlighting, monetary policy credibility is extremely important. As low inflation expectations continue to materialize and we benefit from that credibility that's been built of the last more than a decade, lower nominal bond yields should prevail. That should happen over the long term if the international experience is anything to go by, and the general policy framework is roughly as it has been historically. So that in and of itself may really do quite a lot for stabilizing the debt trajectory, and we'd realize significant upside on our bond position in that scenario. But we do have to take into account the fact that it's very, very plausible that that does not happen. None of those three factors which would stabilize the debt trajectory, none of them are inevitable. So it's very important in the investment strategy to take that into account and to invest for divergent outcomes, especially in South Africa. Excuse me. So this is three of the kind of very high-level ways in which we're thinking about how to manage that huge discrepancy between how things could go. In the income context, we are offsetting our long-dated nominal bond exposures with quite aggressively with low duration stuff, low duration floating rate notes, and then incorporating a higher weighting to inflation-linked bonds, which would actually benefit from, or potentially not benefit, but protect you from a higher inflation outcome, which, as I said, may be politically enticing at some point. And then even a small offshore exposure can, and when I say small, I mean below 10% of any income fund, because they are inherently domestic funds, but even that can do quite a lot to smooth your bond volatility in South Africa, because they do tend to correlate negatively during normal market periods. In the local equity context, we prefer investments where the valuation multiples do leave some room for low growth outcomes. Because as I said, on the current baseline trajectory, we're not expecting nominal GDP growth of much more than 6%, and you wouldn't want to be pricing in much more than that in an equity valuation, especially one that is exposed to South Africa predominantly from a revenue perspective. So valuations are very, very important, and I think that our team is particularly sensitive to that in the management of local equities. In the multi-asset context, we definitely aim to balance the local exposures as responsibly as possible. So when I say responsible, I mean it's not necessarily responsible to be 100% offshore, but equally so, probably not to be 100% local in situations where explosive debt dynamics are a plausible outcome. So that offshore exposure is got in different ways throughout our funds. Some of it is direct, but a lot of it is indirect. And I know our equity team has done a lot of work on what your true look-through exposures are in the local equity market, and really the local stocks have done a lot of the work for you in kind of externalizing their revenue streams. So those are the three investment implications that I want to leave the audience with, and I think that we should go into Q&A for the last 15 minutes. If you do have some questions for us, please, Jaco.
Excellent. Daniel, thank you so much. Rayon, I don't know if you can maybe join us for the Q&A as well. There we go. Thank you. And Daniel, Rayon, thank you so much for taking us through your thoughts. It certainly is food for thought. And I think we can resoundingly say that it's not a definite that South Africa isn't a fiscal death spiral as such, but we certainly do need some action to be taken. I think that goes without being said. We've received quite a few questions, so thank you for that. So if any of the audience members do have any other questions, please do keep them coming. I'll work my way through from the top to the bottom. So the first question here that we have is, Daniel, I'm going to put this to you. It basically comes down to, can we expect tightened exchange control in the near future, given what we've said in regards to, requiring growth or inflation as a solution,
Yes.
what do you think? What are your thoughts on tightened exchange controls going forward?
Yes.
I think that'll,
Yes.
yeah.
Yeah, I think it's a good question. It's definitely something to think about, especially if you're taking a more bearish view on whether or not some of the growth and fiscal measures which are required are plausible, to stabilize the current debt trajectory. Because if you get on, or if you continue on an explosive path, there is going to be the temptation to do something forceful about it. And one of those measures is to close the capital accounts, the same way that we have seen that in Turkey and in Nigeria. I think that in South Africa, the situation is interesting and more nuanced, in that if you look at the actual experience of exchange controls and how the government has evolved those over the last 20 years, we're actually going in the other direction. Personal offshore allowances have been relaxed generously, to the point that for most individuals there is no offshore restriction. Reg 28, the legislation that applies to pension funds and similar kind of products, recently been relaxed to allow an offshore exposure of something in the 40s now, from something in the 20s just a decade back. So the experience that we're having is one that is not particularly concerning from a capital controls perspective, but there may be a point, especially if you continue on that explosive path, that that changes, I guess, especially if there's political change. But there are other ways to achieve similar objectives without closing the capital account altogether. The one way, and I know this is a very popular kind of theme currently amongst wealth managers, is the potential for prescribed assets. So, where you effectively force pension funds to participate to a certain level in the government bond market to fund that deficit at whatever price. I think it needn't be, the reality needn't be that dramatic. There are ways to incentivize participation in bonds. And in fact, the global best practice already allows or gives banks and insurance companies a big incentive to participate in deficit financing, because it's much less capital intensive than other financial instruments to do that. So just the regulator just gives you some relief if you participate in those bond auctions. So we may see some more movement in that regard at some point if it really becomes an issue. But I wouldn't say as a base case that we should expect to see the capital accounts to close completely under the current kind of regime. But as I said, the longer these yields persist, and if nothing changes, it's very plausible that the situation is very different 10 years from now. And of course, that anything can happen in that situation. Yeah.
Absolutely. Okay. Second question that I've got is and I've got a quote here. Has Ramaphosa's crackdown on corruption resulted in expenditure and any savings for government to boost infrastructure spending? And I think that goes to, if I interpret that correctly, you had the slide earlier where, there are certain areas where we actually cut expenditure. Are those numbers reflecting, in the numbers that we've got to our availability? And, has it had a positive effect in your view?
Yeah,
Daniel?
I think not particularly yet. That's not to say that it won't have an impact. Of course, we don't know what the alternative universe would have looked like, where there's just obviously looting on the scale that existed prior to the current regime. But I don't think it particularly moves the needle on the expenditure and revenue front yet. I think where we've benefited already is where high commodity prices have caused quite a nice windfall in revenue collections in South Africa. The majority of that revenue windfall has already gone to special grants associated with the COVID pandemic. So when you look at the high level numbers, just revenue and expenditure as a percent of GDP, you don't actually see a huge benefit in terms of the difference between those two numbers yet from high commodity prices, because they've been allocated largely to relief. So I think the short answer is no, not yet. But of course, as we said, on the expenditure front, we know with fairly high degree of confidence that a significant chunk of GDP is being wasted and could probably earn a higher return, if spent efficiently. So we don't really know what number that is, and we don't think that we felt much of a benefit yet. But perhaps over the fullness of time, if they have success with reducing the extent of looting at national and municipal and provincial government, then we may see some benefit. But the short answer is I don't think so yet. It requires more direct action. Yeah.
And many years of implementation and continuing on that path, obviously, yeah. So it's, I know it's a tough question to answer, explicitly. So thank you for that. The one question that have come up 3 times since we've closed the presentation, and I do want to put it to you because I do think it's an interesting question. It basically comes down to the scenarios that we've sketched, where we've got the, going to 200% in debt to GDP, and I want to put this to both you, Daniel, and Rayan, and the Goldilocks scenario. We sketched 5 little, scenarios. And the question from all 3 of these participants were, what is the likeliness that we can expect a Goldilocks scenario? Once again, it's very difficult to answer explicitly because it is a forecast. But I mean, in essence, we do not necessarily expect, and this is what the one commentator or audience member said, we're not expecting a death spiral. We do expect to be some kind of blowout or some kind of, interjection of some kind. If you can maybe just talk to the likeliness of having either of those scenarios play out.
Well, I generally don't like to think like that anyway. It's too complex a system, and the variables are too intertwined to really come to a conclusion on that front with any conviction. But so I like to show you the outcomes and then make an investment decision on the basis of what is plausible. And I think both of those scenarios are plausible. And I think the takeaway for us is that firstly, on the monetary policy front, South Africa scores really, really, really strongly, like top 10 percentiles globally. And that should have, if it continues, a really positive impact on the perception of South African bonds and the value that's available. But secondly, that on the fiscal front, which is where most of the risk lies currently, that it's entirely plausible that things go fine. It's entirely plausible. We didn't have to move our assumptions too much to get to a situation where debt dynamics are relatively stable, the Goldilocks scenario, which I showed you. Yes, it requires an improvement in growth conditions, but that is plausible. That has happened before. It may happen again. We may get, especially as the Eskom constraint is slowly relieved. So we'll get up to something like 3%. It's not difficult for a country at our level of income to get up to 3% real GDP growth. It's not difficult at all. You just have to relieve the constraint. And in that scenario, you will find the bond yields coming down most likely, and you will find better budget balances, all feeding off of each other in the circular and complicated relationship. So I don't have a view on which is more likely actually, and we don't like to think like that generally. We just want to assess and understand those risks properly so that we can position the portfolios so that they don't completely collapse if either one of the scenarios plays out.
And I think that is an extremely important, it's one thing, doing all this research, but there's a purpose to it. At the end of the day, the information that we gather and the tests that we do and the risks that we judge along the way is about putting a portfolio together, because at the end of the day, we are the stewards of your investors' money in whichever portfolio you choose to invest with Counterpoint. So I think that becomes very important. There's a question here as well, can we afford NHI? I'll answer that. The answer is no. I don't think we can. So I don't know if you guys have got any other comments on that.
No, I think that's covered it.
Thank you. So we'll move on. Rayan, then the long-term effect of the Ukraine-Russian war on our SA economy. What is the impact? What sectors and companies are you avoiding because of what is happening in Russia and Ukraine? It's really topical. If you maybe can share some thoughts on that.
Yeah, so difficult question.
Sorry.
Not exactly the expert in geopolitics or wars per se, but I think there are a few themes that come out to the forefront when I think of this. I think let's go first, let's go and negate someone.
Mm-hmm.
From a naive macro perspective, top down, I'd say probably to avoid Europe. So we've done some internal research and just looked at the reliance of energy coming from Russia, and majority of Europe is massively affected by that. I mean, you have Germany with about 60% reliance there, and there are some countries up to 100% reliance on Russia for energy. And I mean, the whole of Europe is basically interlinked. So as soon as you have this problem where I mean, you can see how it negatively impacts us when we don't have energy for hours in the day. It definitely
Mm-hmm.
does impact growth forecasts, and there's a high probability that there'll probably be a recession in Europe, possibly by end of the year. And that just seems to be market consensus, not just my perspective here. So that's
Mm-hmm.
just from the negative aspect. So I think a more simplistic answer is that higher energy prices globally may persist, and this will provide you elevated levels of inflation, in which case I think you want to avoid companies that have the inability to pass on rising input costs. So said in
Mm-hmm.
another manner, invest in companies with pricing power and stocks that benefit from inflation. So I'd suggest potentially commodities and food retailers. They tend to have the ability to actually pass on inflation. And
Okay.
just probably just a bit of take-home information for the audience is, what does Russia and Ukraine actually supply to the world? So oil and gas, that's the obvious one.
Mm-hmm.
Commodities, I mean, PGMs, Russia actually provides a massive amount of that. And I think that that environment there where people are sanctioning Russia is actually a bit of a tailwind for South Africa. We a
Mm-hmm.
beneficiary, since we're also a massive PGM producer. And if they're not buying from Russia, it can actually help SA. So in Daniel's Goldilocks scenario, yeah, we have potentially a tailwind here. And then apart from that, soft commodities, meat, corn, fertilizers. That's what else they actually produce and provide to the rest of the world. So again, the theme of food security.
Mm.
So again, those are the stuff
Yeah.
I'd be looking at.
Yeah, and just further to Daniel's comment earlier, about the complexity of and how these things are intertwined. You can't change one thing without having unintended consequences. The internally in preparation for today's webinar, we also spoke about these gas fines, potentially on the coast of South Africa, Mozambique. These can have a significant impact on improving the balance sheets, etc. of South Africa, should these be developed, in coming years. And so they can definitely have a positive impact too. Really thank you for your comment as well. It certainly is much appreciated. Guys, we're running out of time, so I'm gonna close. Any closing comments, Daniel, from you and Rayon? Maybe just a quick minute, 30 seconds, 60 seconds. Daniel?
No, I just want to thank everyone for joining us, and just to appreciate that the basic case is that in our two pillars of bond market analysis, and this applies globally, we have a monetary pillar and we have a fiscal pillar, and South Africa scores really well on the monetary pillar. And on the fiscal pillar, where the risk lies, there is a very wide spectrum of outcomes which is possible. So we still see value in the local bond market, especially the long end of the bond market, where if inflation expectations continue to remain relatively anchored, you're going to realize a lot of upside. But we constrain ourselves and kind of diversify that exposure to a pretty significant degree in our income funds, because we do recognize that other outcomes are possible, and that was really the point of this webinar. I just wanted to re-emphasize that. Thank you.
100%. Thank you, Daniel. Rayon?
Daniel obviously summed it up quite nicely there. Is that I mean, the title may have got the audience here, but we're not probably as bearish as the title actually indicates. We just obviously wanted to make the audience aware of the potential risks, and that we are prudently looking at the portfolio and kind of evaluating all risks when we make decisions as the custodians of your wealth.
Absolutely wonderful, Daniel. Rayon, thank you so much. And just in closing, guys, we've got three portfolios within the fixed income strategy. We've got the money market fund, if you're looking for a money market fund, please reach out to us. It's been a top performing fund since its inception. The Enhanced Income Fund, it's a very well balanced portfolio and a fantastic solution in the fixed income space. And we also have the Preference Share Fund that sits within the fixed income strategy. There has been some change in mandate as well as a name change that was approved yesterday, actually, in fact. And we will be putting together a small official letter that we will be communicating to investors in that fund, just to make them aware of the intricacies of that change. It's not a massive change, but we do need to change the mandate to allow for more counters in the portfolio, as the preference share sector has shrunk quite significantly in the last 12 months specifically. Then the Enhanced Income Fund is available on Easy Equities, guys. So if you do interact through that platform, please, it is available, so you don't have to look far. Then if you've got a minute at the end, guys, please complete the survey for us. It's literally going to take you 30 seconds. Your feedback is extremely important to us. And then our next webinar will be on the 18th of May, and that'll be a Coffee with Counterpoint session where we generally discuss topical, topics that is current in the investment industry. And as it is, and as a Star Wars fan, I will use this opportunity on the 4th of May to say, may the 4th be with you. We'll see you in a couple of weeks. Thank you. Bye-bye.